Hello, everyone, and welcome to another power packed webinar by YES Securities, where we are committed to empowering individuals with the knowledge management products to wealth management solutions. Our goal is to pave the way for brighter financial future for all. One of our flagship offering is chlorophyll, inspired by the pigment that fuels plant growth through photosynthesis. In the same way, our comprehensive stock strategies breathe life into client portfolios, providing the oxygen and greenery needed for wealth to flourish. Today, let's give a warm welcome to Mr. Nitish Bagde, an industry expert with 25 years of experience in technical analysis. With a deep understanding of market dynamics across commodities, equities, and derivatives, he is well versed with a predictive analysis as well as reactionary analysis. Nitin is here to guide us through. So buckle up as we dwell into the world of finance, guided by actionable insights and commitment to your financial well-being. Today's webinar focuses on exploring Indian capital market returns, uncover the latest trends, strategies, and opportunities in the dynamic world of Indian investment. Over to you, Nitin.
Hello, everybody. Thank you very much. Good evening. So, today the topic is trend following with moving averages. Uh, this is part one because this part will cover the academic and theoretical part, whereas part two will contain the practical examples and how to use this for trading purpose as well as for investing purpose. So as I was saying that today we will be looking at trend following with moving averages, how to use moving averages in trend following. Let us start with what is actually a trend. When we say trend in stock markets or in any financial market, so we'll just cover the theoretical side of it first. The first person to speak about trends was Charles Dow. He was the first editor of Wall Street Journal, and he discovered that stock prices moves in a trend in late 1800, around 1895 or 1896. So Dow was the first editor of Wall Street Journal, and he wrote many articles about trends in his journal. Dow expired in 1902. Thereafter, Mr. Hamilton took place of Dow. He became the editor of Wall Street Journal. And thereafter, Mr. Ray became the editor of Wall Street Journal. These two persons collected all the articles of Dow and whatever he discovered and presented in a book. So basically, Mr. Ray made all this work. He published a book about trend following of Dow theory, and it is known as Dow theory. So trend was discussed first time in Dow theory, and therefore Dow is considered as a father of modern technical analysis. Dow basically divided trend in three different parts. So trend is nothing but a shape. The prices make that shape on chart, and it is basically a higher high and a higher low. You can see that this is high. The second high is higher than the first high. The third high is higher than second high, whereas the bottoms are also higher. So this is the uptrend. When the reverse of it happens, that is lower highs and lower bottoms. That is downtrend. But uh, Dow divided trend in three parts. The first part is, and the larger part is primary trend. Dow basically said that primary trend goes on for years. So primary trend is the basic trend. Uh, we can say that this trend, the question must arise that on what time frame these trends will be visible. So trends are basically fractal in nature, and they repeat themselves on every time frame. If you see the monthly chart, you can one can see a trend. If one sees the 5-minute chart, the trends are present there also. The only difference is that the higher time frame we use, the more stable the trend will be. The lower on lower time frames, the trend will not be that stable. More type of zigzags will be there. So basically, this is the primary trend, and inside this, other type of trend will come. Like this is secondary trend. In primary trend, when a correction occurs, a opposite price movement happens. That is known as secondary trend. Dow uh, Dow was of view that primary trend can be predicted, secondary trend can also be predicted by using different tools. We will be coming to those tools, but the main is primary trend, and inside that there will be a secondary trend which will be against the direction of primary trend. The third uh, constituent is minor trend. So minor trend will be present in upside also and in downside also. Dow was of view that minor trends cannot be predicted. Primary trend one can predict, secondary trend one can predict, but minor trends cannot be predicted. That means the work of area or to take a trade or to make an investment, our focus should be on primary and secondary. Since minor trends cannot be predicted, we should not waste our time in trying to decipher the minor trend. Now, I'll show you some practical examples. I have used Nifty 50 chart here. This is the monthly chart, and you can see this chart is since 2003. It is on semi-log scale, and one can see that a green line going up. This is basically the primary trend. The trend of Nifty since 2003, the primary trend of Nifty since 2003 is up. Now this opposite moves, these red opposite moves is secondary trend, and the purple color small moves are primary trend. Secondary minor trend. So our objective is to find out the end of secondary trade so that we can enter our position and ride all the minor trends. One should not look to enter into downside minor trend because the fluctuations, volatility may go against the trader. So our focus should be on knowing the secondary trend and its conclusion. Once we are able to know the conclusion of secondary trend, then we can enter our position and ride the trend. The question may arise that how can one use monthly chart and do the trading? So as I initially said, the trend is fractal in nature. That means it will repeat itself on every time frame. So first one has to decide what time frame here one needs to trade, and based on that one can decide where on what time frame one must see the primary trend and secondary trend. For example, the weekly chart also shows primary trend, secondary trend, and minor trend. If one is trying to trade on using daily chart, then he or she should know the primary trend of weekly chart. If one is trying to trade weekly chart, then he or she should know the primary trend of monthly chart. So generally, while trading or while investing, one must use two base charts. One where the primary trend is decided, and second, a smaller time frame chart where one can decide the entry and exits. So on daily chart also, it is clearly visible primary trend, secondary trend, minor trend. Minor trend can be both ways, up and down both. If one wants to trade intraday, then he or she must know the primary trend of daily chart. One must always trade in the direction of primary trend. That is the basic rule. One must always try to trade in the direction of primary trend. If one goes against the trend, primary trend, then the trading or investing may not be that much successful. So one needs to know the primary trend as well as secondary end of secondary trend. So there are two opportunities one can get. First, when the primary trend is changing from down to up, that is the first opportunity to write the basic trend. The second opportunity will come whenever the secondary trend, that is the of opposite price direction, when it occurs, one may try to find out the conclusion of it, so that he or she can make an entry. So in trend following, we get two type of opportunities. First, when the primary trends turn positive or changes from previous trend to new trend. That is the first opportunity. Here, one can have a longer term trades, longer term. Whereas for shorter time frame, shorter term trades, one has to look for corrections, that is secondary trend, find out the conclusion of correction, and then make an entry. How to do this? Because on naked chart, a person may not be able to pinpoint where a secondary trend started, where it ended, where the primary trend started, where it ended. For this purpose, we will be using moving averages. So moving averages is nothing but a summation, average of prices for a particular period. So you must have heard that 50 days moving average, 200 days moving average, 20 days moving average. The 20 days moving average means the average of 20 days price. And since every day a new data point comes in, so that is taken into calculation, and the last one is removed. Therefore, this average is always moving. With every addition of new data point, the moving average will have additional data points, and it will keep on moving with price. Therefore, it is called moving averages. There are many type of moving averages. The simple moving average is the simplest one. Suppose for finding out 5 days moving average, you add the 5 days prices and divide it by 5 number. So the product is the moving average. You keep on doing this every day, and you will get a line which will be simple moving average. In its short form is SMA. The next one is exponential moving average. So exponential moving average is bit it reacts bit early, since the last data points have more weightage in the calculation. It is not simply 5 period summation divided by 5, whereas in it the last two or last data point is given more weightage, so it uh, curves more in the side of price. And there are other many type of moving averages, weighted moving averages. uh, Few new moving averages also have come few years back, that is adaptive moving averages. But we will keep it simple, will not go into the intricacies. And here the orange line is simple moving average, and the green one is exponential moving average. The period I have used is 200 number. Generally, 200 days moving average shows the trend of a year, because there are 365 days in a year. There are 52 Sundays, 52 Saturdays, so 104 days are holidays. Uh, Apart from that, there are few other holidays. So generally, in a year, stock market or any financial market works for 200 to 210 days in every part of world. This is the general uh, consideration, that in a year the markets will operate for 200 days, and therefore we use 200 days moving average. Now the basic rule is simple: till the time prices are above moving average, the trend is up. Now here on monthly chart also I have used 200-month moving average. This 200 number or 200 moving average is used by so many people all over the world that it works on every time frame now. Basically, it was derived for a daily chart where a year's trend was the objective, to find out year's trend. But then so many people started using it that market generally started following it. And later on, people started using it on weekly as well as monthly also. So what this 200 moving average implies? The 200 moving average implies that till the time prices are above it, the primary trend is up. 200 moving average is not speaking about intermediate trend or minor trend, secondary trend or minor trend. It is simply telling us that till the time prices are above 200 moving average, the primary trend is up. Another number I use is 34 moving averages. So 34 moving averages tells us about secondary trend. Once the price crosses below 34 moving average, that means secondary trend has started. That means correction has started. If you see, if my cursor is visible, there is a small down move here. There is another down move here. There is another down move here. These are small down moves. This is a monthly chart. These down moves have not crossed below 34 moving average. That means the secondary trend, the primary trend is up, as well as secondary trend has still not started. The time it crosses below 34, that means secondary trend has started. If we combine the two, if the prices are above 200, that means the primary trend is up. If the prices are below 34, that means intermediate trend is down. Here, once one should then look for an opportunity to buy. This is the buying zone. When it starts trending below 34, then one should be alert to find out a reversal. There are other methods to find out a reversal. But our basic objective by using these two tools is that whether the market has entered secondary trend, and is it still is the primary trend is it still up, then it is a buying opportunity. Sorry. There is one problem with moving averages. The simple moving averages, if 200 moving averages I use, then it will start only after 200 data points. If 34 moving average I use, it will only start after 34 data points. That is the only problem with moving averages. Rest, it is the one of the best tools, one of the simplest tools to find out the opportunities to enter the market. The simple rule is that whenever the prices are above 200, that means primary trend is up. So higher prices can be seen. One should wait for cross below 34 moving average. That means secondary downtrend has started, and one should be alert to find out a reversal. Uh, you must be remembering the last session we took, that was about candlestick patterns. In that session, I have given few candlestick patterns which indicates the reversal. In this condition, if such type of candlestick pattern occurs here, then it is a signal of going long, LONG long, not WRONG wrong, or it is a buying opportunity. This setup can be used on any time frame. This is the weekly chart. Here the primary trend is up. Here the secondary trend downtrend has started. We go on. This is weekly chart. We go on daily time frame and wait for a candlestick reversal pattern. Whenever it comes, we should be long. It even works on daily time frame also. See how beautifully it came down to 200, and since the primary trend has to remain up, it didn't cross below 200. So since it didn't cross below 200, the primary trend is up. It has crossed below 34 days moving average. So intermediate trend, secondary trend is down, and one should be alert here to find out some reversal pattern on this chart or lower time frame chart. In case of daily chart, the lower time frame chart will be 75-minute chart. One can even use hourly chart, but the better would be 75-minute chart. Now the question may arise that why 34 number? Why not 20? Why not 5? Why not 50? Why only 34? So basically, when a larger time frame trend, suppose a monthly trend is up, and weekly trend has become down, that means weekly is falling. So that weekly falling will look like something like this 2008-2009 period. The monthly will close below 34 moving averages. Here actually this is a secondary trend, but on weekly chart it will look like a downtrend. You see here 200, the prices crossed below 200. This part 2020, on weekly chart the prices crossed below 200. That means the weekly trend became down here, whereas on monthly chart it was just a secondary correction, secondary trend. So looking at monthly, it would be a buying opportunity. Whereas if we look at only weekly, then one would have a interpretation that the trend of market has turned down. No, since the larger time frame is in uptrend, primary trend is uptrend, and secondary trend has started. Therefore, this downtrend on weekly, the lower time frame, will be a buying opportunity. So now 200 days, when we convert it into weeks, in a year there are 52 weeks, but if we consider the holidays and all that, then it comes around 34 number. So 34 week is a 200 days moving average. Sorry, reverse. 34 on daily chart, 200 on daily chart will be 34 moving average on weekly chart. 200 on weekly chart will be 34 on monthly chart. So on single chart you will get two informations. On weekly chart, when 200 is the prices are above 200 and prices are below 34, that means on daily chart the prices are below 200. That means on daily chart the trend has turned down, but since the weekly primary trend is up, then it is a buying opportunity. So on single chart we can use two different moving averages, and this is the reason of taking 34 number. 34 is also a Fibonacci number, so it works both way, as well as Fibonacci, as well as it represents a year. If calculated on basis of weeks, it represents 200 of lower time frame. So this way, the moving averages, by using these moving averages, 34 and 200, one can know the primary trend, secondary trend, and minor trend. During minor, till the time prices are above 34, the minor trend is up. When it comes down below 34, the secondary has started and minor has also turned down. So we need a situation where the prices are above 200 and below 34. That is the best place to take a trade. How to take a trade? The practical examples that will be given in next session. This session was only academic and theoretical part, how to calculate moving averages, how to deduce the trend, how to identify the trend, and how to, by combination of two moving averages, we can uh, know the trend as well as buying opportunity. The simplest form of buying opportunity will come when the prices are above 200 and below 34, and some sort of reversal from, one can use candlestick, some sort of reversal comes there. That is the point where it is a buying opportunity. Now, few more things about the trend which Dow mentioned. He said that primary trend is inviolate. That means nobody can, no event or insider trading or making up the prices. These all things cannot be done in primary trend. In minor trend, one can manipulate the market. During minor trend, one can manipulate the markets. Sometimes around secondary trend also one can manipulate the markets. Events can play havoc with the prices, but during primary trend, no one can manipulate the primary trend. The higher the time frame, Dow said about monthly. So from this we can say that every time one should trade in the direction of monthly trend only. If the monthly primary trend is up, then one should only play long. If the monthly primary trend is down, then one should always only play short. One should never go against the monthly primary trend. The second point Dow mentioned is that the averages discount everything. Averages, by averages means he mean that indices, S&P indices, Nifty, Sensex, all these are indices, indexes. So Dow meant by saying that averages discount everything. By this he mean that individual companies, there may be some news flow, there may be results, some news flow. Everybody remembers the in between few of the stocks, those open 20% down because some news was there. So by this document that trend discovery or trend finding will always work better on the averages. From average, we one should not directly apply it on stocks, but in combination of averages, the stock should be seen. Since averages cannot be manipulated. Third point Dow mentioned is that Dow theory is not infallible. That means Dow theory can also fail. In technical analysis, nothing is nothing is there that always work. One or the other time, at some point of time, the tools will fail, and that is true with Dow theory also. But then why should one use if there is a probability of failure? Because the probability of failure is very less on each and every markets, international markets, commodity markets, crude, everywhere the trend is working. Few of the times it may fail. So if we bet for say 10 times and 2 times it fails, 3 times it fails, there are 6 or 7 times it works. So in trading or investing, basically if number of times we make money and that is more than the number of times we lose money, in totality we are making money. So trends can also fail, and therefore the stop losses should be used. How to place stop loss, how to use stop loss levels, that we will cover in our next session. With this, I am ending my session here. Any questions? If any questions are there, you can key in this comment box, and I'll answer it. If you have a few more questions, then we can, if it is about more technical questions, then we can discuss them in next session also. Thank you very much.
Hi Vijay, Candlestick recording is already available on our YouTube channel. You can check from there. And even this one will be also available in next 1 or 2 days on YouTube. So we'll conclude this session. So as we conclude today's webinar, I want to extend my sincere thanks to Mr. Nitin for sharing his expertise and insights with us. Remember, at YES Securities, we are here to support you on your financial journey every step of the way. Stay tuned for future webinars and updates from YES Securities.